Sonja, talk to us about this. We're seeing red across the screen. Earnings on both sides of the Atlantic are not looking good. Is this a panic moment for equity investors?
I wouldn't call it a panic moment if you consider that the weakness today is against the backdrop of course, a very long period of incredible strength across equities, globally, actually. And you've picked it up, right? There's a number of global themes that are impacting earnings, and they shouldn't be surprising. If you start with what's weighing on the Kakaron today, it's the China story. Now, Chinese economic data is not bad since yesterday. There has been trouble for quite some time. So to assume that the Chinese consumer might not necessarily continue with their incredible support for luxury goods, I don't think is surprising. What you're seeing today is finally the evidence in numbers. So the market reaction is actually quite natural to what should have been anticipated in that context. Now, the mixed picture across the banks, again, we should be very careful to generalize because, of course, the business setup, the business mix of the companies that reported this morning is very different. So what is the strength potentially in Spain is very different to what drives Deutsche, because clearly the exceptional charge they had to take is not something we expect to be repeated next time. But again, you had the Deutsche Bank chart on earlier. You look at the one-year performance of the company, and it's a setback now. It might well be it's the lack of a further share buyback. You know, there might be immediate triggers on the day, but analysts and investors very clearly will look at the repeatable and sustainable earnings profile of most of these companies. But don't ignore the macro factors. And coming back to the MAX 7, I read a wonderful headline this morning, the magnificent correction, and we shouldn't dismiss it, right? Because we've been looking at these companies and they've been driving the vast majority of the index level. But the expectations were for roughly 38% of earnings growth.
Yeah.
And you wonder, how sustainable is it? Are we ending up at 30? It's still a formidable number. But you need a readjustment process for what has been an exceptional journey for these companies.
So you said pay attention to the macro. There's layers to that. Is the monetary, is it the fiscal? And within fiscal, I'm putting in the geopolitics as well. What drives the next 6 months?
To start with, it's all of the above. But as investors...
You got to pick one, Sonja.
No. You need to break it down. Because you shouldn't try and put them all into one big picture. You need to understand what drives fiscal, whether this has then implications on inflation, and then you have the monetary reaction function to it. Hence, it will be the US election. If you consider the data we have been seeing, and we, of course, now had a surprise turn, so it is probably far more open than what it was prior to the changes over the weekend. But what we do know is that both parties actually are supportive of further fiscal expansion. Now, a Republican clean sweep, we know, would be more inflationary than a Democrat clean sweep. And with Kamala Harris now in the picture, this might be less likely. This is important to understand because elections create a lot of noise. But only if we have an indication that it really changes growth and inflation, will the market react to it. The US election will be such a big driver of that understanding. And this is important for the yen you talked about this morning, EM currencies. Because if the Fed is allowed to cut, that eases up the path for all these countries to react to it. A weaker dollar always benefits EMD. But you need to understand the reaction function across these, and this is where the election is your starting point to understand the wiggle room for the Fed.
And how do you position then ahead of the election, Sonja, when the polls are uncertain, they're in flux because we have new people in the mix, or one new person at least in the mix, and yet you describe a situation where on the inflation and monetary side there are going to be big differences between these two candidates. So do you position for one outcome or the other, or is it much more nuanced than that?
There's a third factor that you have to put in its valuation levels, because the asymmetry potentially on the back of what we might see is not, of course, the same. So there's been a lot of talk, of course, on spreads being at nearly 20-year lows in terms of tights. You have equity valuation where would be very mindful, and it's interesting to see the rotation we've already seen towards domestic stocks. But of course, with the closer we get to it, and we have to wait for the Democratic Convention, you will get more clarity on the actual plans that both parties will put forward. If the soft landing, and we have to take a step back, if the soft landing continues to materialize as it currently is, you might well see spreads where they are. So you have very little upside, but of course, unless you see further weakness in growth, you probably have just a sideways and you clip the coupon. But that would be reasonably attractive for equities as well, if you consider the potential rotation. I wouldn't try to position too much, because it's never been a good strategy to try to front-run your thoughts on polls and the potential outcome. There will be sufficient time to get closer, to get more clarity. And as it stands, we have seen the polls shift quite significantly already. You might well wait and see. And as we see today, you might see far more focus on the immediate impact and the understanding of where earnings will end up to supersede this with politics.
And what do you position for in China? Because there's a lot at stake for European corporates in China, and we've seen quite a bit of disappointment expressed in stocks, but also in commodity prices around the most recent meetings in China and the policy changes that didn't come out of that. Are you positioning for just more of the same, this sort of slow grind on the China story?
We are more neutral for the very simple fact, yes, the data is all bad, and we had the latest round in terms of credit growth, GDP. We know the imbalance, that consumption still is not high enough to outpace or to overcompensate the decline in investment. But, of course, Chinese assets are cheap. So you have to beware of the potential stabilization and hence more nuanced measures from the Politburo in terms of stimulating the economy. And that, of course, would then have not only implications for Chinese assets, but, of course, would potentially have a positive read across for all those companies, predominantly in Europe, that have large businesses in China.
If tech sells off and the market broadens, does the index go up or down?
That is, I think, a mathematical equation, because it depends on both sides moving, right? The concentration risk is such that it depends on the magnitude of the sell-off. And it depends even more so where earnings expectations settle. Because it's fascinating. Overall, for the S&P, you're currently sitting at 10–11%. Yeah. As I said, that was starting 38 for the Max 7. It was roughly 7.5 for the rest, and rather negative, slightly improving for oil and materials. Yep. It's a fascinating divergent picture, and depending on where it settles, you might see the outcome for the S&P.
I have not been paid to be in a diversified portfolio. I have underperformed in a diversified portfolio for quite some time now. Yes. Is that diversification about to pay off? Yes, our assumption is it is, and not just from an equity standpoint, but in general. Yep. Because, of course, the diversification didn't pay off. Equities would have done the job, right? So there's the story within specific indices, but there's a broader picture as well in the context of all the influencing factors we've discussed this morning, and how you think you can construct an asset allocation that will shield you from the potential asymmetry of eventual shocks or the implication of surprises from elections. OK. So just thinking about, therefore, what I do going forward, what does a diversified portfolio look like that's going to protect me from some of that uncertainty? So, the good old, fixed income, equity, private markets will increasingly play a role, because you will see a level of uncorrelated revenue streams that will help you a lot in that context. And if you look at duration, if you look at rates where they are, the diversification benefit potentially is far higher than what it used to be. We're confident that equities and bonds are going to be antagonistic? Yes, for the time being. Of course, we had 2022 as the major driver against this, but proving the opposite. But over the long term, and in the context of where we're currently operating, we still believe that there's benefit in diversifying that way. But, as I said, not fully. So it's not just a classic 60-40. This is where private markets will play such a big role. So you're diversifying across a broader range of asset classes and more nuanced in the context of the individual areas. Because if you look at the steepness of curves around the world, right? Yep. Big differences. So this is not one trade that you say, I'm buying the steepener, because that will not pay you any money. You have to be more nuanced, where you see the opportunity set arising. And, in fact, we have been placing the steepener trade on and off, because there is momentum behind it, but you have to be very targeted in what you're looking for. Absolutely. Sonja, great to see you. Thanks for stopping by to see us. Thank you. And fantastic jacket. Thank you very much indeed. Sonja Laud, CIO at Legal & General Investment Management. Thank you.